Hello ladies and gentlemen, and welcome to this Koda Capital Investment Strategy Update. My name is Paul Heath, I'm the CEO of Koda Capital, and it's my pleasure to host you here today. Well, what an extraordinary 12 months 2020 has turned out to be. When we stood at this place in 2019, none of us could have anticipated the extraordinary events that were in store for us. Global pandemic, the enormous loss of life, tragic loss of life, things like the US election. And of course, from an economic point of view, 2020 saw the end of the longest sustained period of economic expansion, followed by the shortest economic cycle in history, unprecedented market moves. It's been an extraordinary time. And in that context, we thought it was appropriate that we talk to you a little bit about where we are at in the market today and how we're seeing 2021 evolve and how we're thinking about investing clients' capital in this environment. Before I pass you through to Bridget Leckie, our Chief Investment Officer, some of you may not know a lot about Koda, so I want to take a couple of minutes at the top to talk a little bit about who we are and tell you a little bit about our investment philosophy. Koda Capital is Australia's largest independent wealth management firm, and independence to us is important. We don't believe that you can have trusted advice relationships and hold conflicts of interest, and so we don't. And so we think independence is important. We're owned by our staff and a select number of advisors. 85% of the company is owned by the staff who work in the company every day. And we have offices in Sydney and Melbourne and Brisbane. And we employ about 80 staff across those locations. Typically, Koda clients are financially secure. But our mission is to deliver those clients financial peace of mind. And to do that, we offer our clients 4 key services. The first one, tax and structuring, is about making sure that assets are in the right location, in the right structure, with a really good estate plan sitting over the top of them. Investment strategy is about investing money for the ultimate beneficiaries. For many of our clients, the money that they have invested will outlast them. In some cases, their clients, and in some cases, their children, and in some cases, their children's children. And so we really want to invest with a long-term time horizon in that context. Many of our clients have a philanthropic motive. They will either serve on boards of charities, or they'll have their own private foundation, and they're looking for ways to give back into the community. And finally, for many of our clients, the money that they have invested not only reflects their life's work, but it reflects their hopes and aspirations for their family. And we help our clients have the conversations about how the money can be an enabler for their families and the future they will all want to have. Those 4 key services are what Koda deliver our clients in terms of financial peace of mind. We were founded in 2014. Today, Koda has 80 staff. We advise on about $8 billion of client assets, and we've been recognised independently as successful in each one of those categories: tax and structuring, investment strategy, family leadership, and philanthropy and social capital. Our size of $8 billion allows us to access any investment opportunity anywhere in the world, but we are small enough that every client can be important to us. I want to tell you a little bit about our investment philosophy and the way we think about investing money in the context of those long-term time horizons for the ultimate beneficiaries of the money. There are 3 core principles that sit behind our investment philosophy. The first one of those is building a true diversified portfolio. We can't be certain what markets will do, but by building a portfolio that is a diverse set of risks that derives its returns from different investment outcomes, different economic outcomes, and perhaps even things that are unrelated to investments, means that you can get exposure to the growth of humanity. And we think that's a really important issue. Secondly, if you're investing money across multiple generations, it's not as important to capture every % of upside in markets as it is to avoid downside. We call this upside downside capture. And when we build portfolios, we aim to capture about 75% of the upside when markets are going up, but we don't want to participate in any more than 50% of the downside when markets are going down. inevitably markets will move down. But if we can minimise the fall when markets inevitably recover, our clients are benefiting in that rally from a higher starting point. And it's an important component of our investment philosophy. The last principle of our investment philosophy is that time in the market is more important than timing the market. The truth is we can't tell when it's time to sell everything and convert to cash, and nor can we tell when it's time to deploy all of that cash into markets. But what we do know is that by building diversified portfolios that can participate in the bulk of the upside but not too much of the downside, then our clients can comfortably invest through the cycle. And that's a really important principle in the way we build portfolios. So with that as a background, let me introduce our Chief Investment Officer, Bridget Leckie. Bridget's been with Koda since the very beginning, and Bridget has held roles as an economist, as a strategist, in a vast range of institutions, both in Australia and in New Zealand, and those institutions have either been domestic or offshore. She brings enormous experience. And for those of you who have seen Bridget present before, she will bring the rigour of data with an entertaining factor as well. So we look forward to working with you more. I'll have a little bit more to say at the end of the presentation, but in the meantime, let me pass through to Bridget Leckie, our Chief Investment Officer, for the investment market update.
Thank you, Paul, and welcome all. When we reflect back on 2020, this does resonate with me. I've been locked down, you've been locked down, companies have been locked down. We think of sports facilities with no spectators. We think of basically no planes in the air. On top of that, major countries have been locked down. The superpowers have been locked down. Simply put, the world has been in chains. And the question I really want to put to you today is this, and that is, what has been the impact of this? To what extent have we distorted the world? I really don't think we can get through this without having some medium to long-term consequences. We know, at least in the short term, the data is significantly distorted. But what else have we done in terms of global superpowers? To what extent have we made shifts in terms of the power of capital vis-a-vis labour? A lot of big questions here. Yet at the same time, we're in an environment whereby what we've seen is that Wall Street has been rallying. Indeed, if we look back just in the last few days, we've seen record highs across equity markets. So I'm sort of highlighting the world is in chains, we're all locked down and not liking it, and we've got real structural rigidities and impairments, yet Wall Street seems to be able to be switching off and rallying to a new stratosphere. So I thought I'd start data-wise by looking at what has driven Wall Street. So when we look at the performance of the S&P 500, and what we've done here is we've just broken it down by key drivers. So if we start looking at since May, now remember we had the big rout in February, March, and then what happened, we got the spring back in terms of from really markets being oversold. So if we look at since May, when we got some degree of sort of normality, whatever that means going forward. When we look at the drivers, the positive drivers since May have been liquidity. And how we've done this, we've defined liquidity as those stocks that are sensitive to bond markets. So they're the interest rate sensitive stocks. Then those stocks that are very, very dependent upon vaccine, so they're more the medical stocks. And then of course, on top of that, the economic reopenings as economies started to reduce their restrictions. And then we had reporting season numbers whereby companies have been able to deliver better numbers than expectations. The negatives that we've seen have been obviously the political risks, the nervousness going into the US presidential election, and then more outbreaks that we've seen recently of COVID-19. So add that up. So where we saw at the 2nd of October, you can see strong gains, and they've been driven primarily by liquidity, which essentially has been central banks using their printing presses, and also the reopenings of economies following the shuttering down that we saw early on in the crisis. Fast forward to where we stand today. We've got the S&P 500 flirting at record highs. Having a look at what's driven this, what stands out, it's the election results. The US election outcome. We didn't see the feared blue wave. If anything, we've ended up with a bit of paralysis on the election front, but nevertheless, that has been seen as a positive. The other one is the vaccine. And of course, there's been a lot of talk here, as we know in recent weeks, that a vaccine is around the corner, and that will provide us with a snapback to pre-COVID-19, i.e. 2019 type dynamics. Then if we look at the negatives, the main one being the outbreaks that we've been seeing in US and Europe. And as we know, they've been really large. And the other political risk that I think is a drag is what we're seeing in China. I think we shouldn't underestimate the pulling of the Ant Financial IPO, because that's signalling a bit of a retreat back and greater rules and regulations going forward. So when you look at that, you can really get a guide as to what has driven the market. Liquidity earlier on this year, more recently US election, and the vaccine. So just covering the election, we've still got uncertainties. We won't get clarity on the Senate until early January. And the vaccine, I'll make it quite simple, and that is that we're skeptical that we're going to be able to get outright herd immunity in a short period of time. I think the risk is it takes longer to deliver, and there are significant speed bumps along the way. So that's the first point I wanted to leave you with. What has driven Wall Street? Earlier on the year, liquidity. That now has run out of fuel. And more recently, it's been the US election and vaccine. The next thing I want to talk about is something I think to some extent that's a little bit alarming. And that is investor sentiment. So what this chart looks at, it looks at how investors are feeling about the equity market on a 6-month basis in the US. And what you can see there is there's been a huge leap towards bullishness. So investors are saying, I'm actually comfortable about the US market on a 6-month basis. I think we've got through the headwinds of this year, and next year will be looking pretty good. Now, I do worry about this bullish type dynamic because it's often contrarian. Think about this mentality of the herd. So what happens? It feeds on itself, and that's when you start to get things really away from fundamentals. And I'd sort of say to you, there are parallels with this and what we saw in the late 1990s. If you recall, that was when we were rewriting financial textbook theory, whereby companies no longer needed to make cash. And if you recall how that ended up. Similar thing if you recall 2007 in terms of, it was alphabet soup. It was all the different forms of debt markets in terms of CDO squared, etc., complicated instruments that were homogeneous and ultimately ended up in the global financial crisis. So investor sentiment is euphoric. Wall Street's been pumped up by liquidity, printing presses, and more recently, I think this desire for the world to snap back to what it was in 2019. The next thing that I'd like to sort of highlight to you, and that is I've given you the market sort of snapshots and drivers. But against this backdrop, and I think you'll all be very, very well versed in this, we've got huge number of confirmed COVID-19 cases. The case numbers are absolutely alarming. You can see in that chart there, the US, these numbers are mind-boggling. And we've got to get through Thanksgiving where 55 million people are moving. And we know and we saw that throughout the summer period, how that culminated in a lot of cases and the big breakouts. Similarly, right through Europe, the numbers here are massive, and they're actually a lot bigger than what they were earlier on in this year as it's broadened. So we've got a huge number of case numbers, and we do know that mobility restrictions, i.e. partial or some form of lockdown, is the only way to really thump on these numbers and to get success for them. But of course, that comes at a price. As you partially shut down economies and stifle economic activity, it causes significant headwinds for businesses. Sure, there are some winners and losers within this, but net, it is a negative. So we have this drain, and we are seeing restrictions on the back of this. And it's interesting going through this year, we've had to rely on different sorts of data to give us a feel as to what lies ahead. A lot of the normal data that we look at has been heavily distorted because of government subsidies and other forms of initiatives which really have sort of put band-aids as to how things really are, particularly the labour market. So one of the best barometers that we've found is the Google Mobility Index, which basically looks at what people are doing in terms of transit, i.e. public transport, going into offices, what they're doing with driving. So it's the moving around activity outside of your house. And within that, what you can see there is that Europe is really starting to come unstuck again as you've seen more and more restrictions being put on board. Sure, they're not as severe at the aggregate level as what we saw in April this year, but you are seeing restrictions. I'd argue they're wider because you're seeing more breadth in countries. And even countries like Sweden that previously went for the herd immunity approach have had to actually move to some degree of restrictions. Point being is that when you get restrictions on activity, that then flows through, albeit with a lag, into economic activity that then flows through into company earnings and ultimately into markets. The US is also starting to see some more restrictions, and I think several governors who previously were wanting to keep things moving have now moved to lock down a bit further. So I think the risk under the new regime is that in coming weeks and going into 2021, we actually see more lockdowns. In our own neck of the woods, Japan obviously not back to where it was, but is getting through this reasonably well. And I think we'll all be very, very familiar with our own situation. But nevertheless, we are in this environment whereby we have a major headwind to growth. Coming back to where I started from, we are restricted. We are living in a life of strangulation in terms of chains. We're not free like we used to be. The other thing that I want to sort of draw on as well, because I know there's been a lot of discussion about this, governments have come to the rescue via, first of all, unprecedented monetary policy. So we've basically got zero interest rates around the world, which you'd all understand when you look at the return you get on your term deposits, and also money printing. What we've seen here has been absolutely unprecedented. We've also seen unprecedented amount of fiscal stimulus, and that's helped to get households through this period. And one of the things that's happened is that household savings in the US since the start of the pandemic, so basically since March of this year, has lifted. And you can see that quite clearly in this slide. And that bar there is just highlighting the savings since the pandemic. And of course, for the consumer, that's providing a very, very nice cushion. Now, first of all, let's just dissect this. You've had trend-like savings, so that's savings that have been going on for multiple years as consumers keep some money away for a rainy day, so to speak. And yes, 2020 definitely has been a rainy day. When we drill down into the composition of the other savings, the big one that stands out there is government benefits. Now, the point we know is that these government benefits in the US are largely expired. They'll be expired by the end of the year. There is not going to be a new government spending package this side of Christmas in the US. And I think there's question marks depending upon the exact composition of the government in the US next year, whether we get some sort of package or not. So I think the jury is all out, but that government benefit, which has been the key driver of savings, that no longer exists. So what that means going forward is that as incomes come under pressure, as I think the true level of job layoffs and unemployment comes through, that savings level that I highlighted right at the start will be depleted. And you're already seeing that, particularly amongst the lower end, they really are already in negative savings. So they've already emptied the piggy bank. So we're losing that savings buffer as well. So just be mindful that we've had a few get out of jail cards, and I think they're now coming towards the end of really that period of where they can provide us with a safety net. So I've given you this picture of we've had Wall Street rallying. We've got investor sentiment that's outright euphoric. I am concerned about the growth dynamics. We've had the easy gains as we've shuttered economies down earlier on this year, got the rebound as we've opened economies. Now with the huge outbreaks we've seen, we're getting more shutdowns. So you will get the knock-on consequences. And you are going to get the knock-on impact also into earnings. Yet when I sort of pull this all together, when I look at Wall Street versus Main Street, so to speak, in other words, the earnings side together with the pricing side, what I see is something that does worry me. So firstly, and this is quite complicated, let's look at the US stock market, and we're going to look at the forward price to earnings ratio. So first of all, I've got there the long run average, and then that green bar there is one standard deviation. Now, plus or minus one standard deviation is technically regarded as wriggle room. So anything in with that is fine. Then when you start to get further out to two standard deviations, that is when it starts to become a bit of a red flag in terms of looking at it from pure financial analysis. And then when I look at where the valuations are right now, they are frothy. You're in excess of two standard deviations expensive in the US stock market. Now, historically, when this has happened, you've either seen a significant correction on the price side, in other words, Wall Street's had a significant fall, or what you've seen is the earnings has leapt up significantly. And we'll delve into the earnings a bit more shortly. Now, this thematic of expensive equity markets, I've highlighted the US in detail here, but it's similar across all the other major markets. So simply put, markets are expensive. The next part of this, and I've sort of touched on this, we've been able to sort of put stocks and companies into two pockets. You've got the winners, and the winners from the global pandemic are what we all know. The move to online retailing, the greater use of technology. To some extent, these winners realistically, it's just an acceleration of long-term thematics and needed a driver to really push it further. You know, I look at my behaviour, I think you'll all be similar. If you look at the amount of online shopping that you're doing now versus a year ago, it's changed. Maybe you were already doing a bit before, but now you're doing a lot more. That's not going to reverse. The fact that we've embraced technology, you know, the Zoom meetings, we may not like them, but I think they are at least partly here to stay. So when we look at these stocks here, what you can see here, and this is the valuations of the winner stocks in global stock markets. And obviously, these stocks have re-rated significantly. So you had the fall when markets all fell February, March, and then since then you've had a big re-rating. So this grouping of stocks is now at new high levels. even though in the last few weeks you can see it's sort of sidelined a little bit. What I think is really interesting is not just this data, but when you lift beneath the bonnet and you look at the earnings side of it. So you would think these winners would have had absolute nirvana in terms of earnings. But yet when we look at EBITDA, so this is the earnings part of the component, that's the average for 2019, which was roughly 18% growth. When you look at the growth this year, it is going to be less than 2019. And that's despite these stocks have had a bonanza of growth. And I put this to you, I can't see how 2021 is going to be significantly stronger for this grouping than what 2020 is. That's highlighting here that these stocks are priced pretty much for perfection. I'm not saying they're going to collapse, but I think the fact that they're potentially going to catapult up significantly further from here, I think is a little bit of a push. This then brings me to sort of pulling that together, and you can see there just highlighting again, one, the earnings side, and this winning group has actually been decelerating, yet the valuation side has gone to the roof. Maybe on 2021 and 22, we just see this group going sideways. That would be a good outcome. Let's now move on to the other grouping of stocks, the losers. So this is this grouping of stocks that have really been hit hard by the lockdowns. So I'm referring here to bricks and mortar retailing. We're referring here to office blocks. We're referring here to online, the media, which a bit might have to go more online. We're referring here to standard banks. So the stocks, the entertainment stocks, those stocks involved, for example, in cruise line, aviation, that's giving you a bit of a broad brush snapshot. Point I'm making here is that these stocks have all collapsed, and you can see it in the pricing side. They've taken a massive dive this year. But I think what really stands out is just recently, what you've seen is these stocks have re-rated. And these stocks are now priced above where they were before we went back into the crisis. But I put this to you, are we all going to get back into the air like we were in 2019 next year? I doubt it. Are we all going to get back on cruises in the same volumes? I doubt it. We may get there eventually, but it's not going to be a 2021 or even 22 story. But these stocks are priced for it. You may say to me, well, hang on, let me have a look at the earnings part of this. And the earnings part of this is going to contain no surprises. Earnings have collapsed. Yes, we expect to see some improvement in earnings next year, but they're not going to snap back. They're not going to snap back to 2019 plus type dynamics, because I think structurally we've shifted. And that came back to the point at the start. There have been and there will be some long-term systemic shifts on the back of this. Typical behavioural theory tells you if you change your behaviour for more than about 3 consistent months, then it starts to become ingrained in lockdown. If we look at our lives now, we've changed things. Some of those things we won't revert back to. We've embraced things that previously we didn't, and vice versa. So the problem I've got with this is this grouping of stocks, this loser bucket, those that have really been dislocated or, more importantly, structurally impaired because of the pandemic, they're expensive. And yet these are the stocks that are really required to lift markets up significantly higher. And I just can't see that happening. So that is, I think, really important given the fact that the winners are already priced for perfection. The other area that I want to touch on in markets, and that is safe assets. I've mentioned quite a bit in this discussion that what we have seen has been unprecedented monetary policy stimulus. So what I've got on this chart here just looks at bond market routes over time, or bond market corrections. Now the first part there, what I've put up there, those lines there or those bars, are the coupon return. First thing that highlights here is that the coupon now that you're seeing being offered on US government treasuries is very low compared to history. The next part I've put on here is capital losses. So this is when you've seen capital losses on treasury return. In other words, what happened, the yields have sold off. But the point I want to make here is that every time you've seen that, what's happened is that the coupon return has provided a buffer against the capital loss. So as a consequence, your net return has had some degree of cushioning. Fast forward where we stand today, there is no buffer in terms of coupon return. Interest rates are about zero. So if we get a 1% rise in yield in 3 months, you can see there you're looking at minus 10% return out of US treasuries. So this is important in the sense of, even if you are believing that it's risk on and that markets will go higher, if we do in that environment get inflation, there's a real risk here, real risk here, because these markets are basically priced for no inflation / deflation. So I just want to highlight safe havens are actually not that. We really have got quite a big distortion in bond markets. So pulling all this together, and I've given you a lot to digest here, what will 2021 hold? I think broadly speaking, there are 3 scenarios. First of all, we get a return to pre-COVID-19 levels. We get the planes back in the air, we get the cruises, we get back to rock concerts, we get back to watching sports facilities with maximum capacity. That's the best case scenario. The second one is we get a partial return to the world pre-COVID-19. So we're still living with restrictions and impediments, but by and large, we're making progress. We're not getting huge outbreaks, and the vaccine is starting to make some traction. The third one is whereby we see escalating outbreaks of COVID-19 and ongoing shuttering of economies. So the waxing and waning, yes, you can open your business, no, you can't, with the ultimate drain on cash flow. I think what we're looking at is probably a mixture of 2 and 3. I genuinely just don't believe, looking at all the different variables, there's any white knight. And unfortunately, when we celebrate at midnight and go into 2021, I don't think we're going to suddenly see a snapback to the old world that we embraced. I think we're in this new world. We've got to live with it. Yes, it will be improving, but it's going to be gradual, and we are going to be dealing with restrictions and more outbreaks at least for another 12 to 18 months. What does this mean for economic activity? Well, let's firstly just focus on the long-term trajectory for US growth. So this is US GDP growth. And if I look at what we were projecting before the pandemic, you can see there that trend long-term growth. I think the fallout of what we're looking at now, the best case scenario, which I highlighted to you before, given we have done damage this year, that's the best case. So you get, using sort of the alphabet, you get the V-shaped recovery. The bear case is where we get the escalating and ongoing outbreaks. And under that environment, we're looking at a much lower growth rate. And with that, obviously, systemically higher rates of unemployment. You're going to get the issues in terms of rising income inequality. Governments are going to have to do more, which also means higher fiscal deficits. It's going to be a slow grind. And then what I think is our base case is that we do improve, but it's slow. We've had the easy gains. following the harsh lockdowns at the start of the year, but we're still going to be waxing and waning a little bit in terms of restrictions and then back to normal, so to speak. But I think that's what we're looking at, a lower pace of growth as the true rate of unemployment comes through. And within that, there is a lot of embracing of technology, and it is going to hollow out a lot of sectors, a lot of industries. They're just not going to get back to where they were. So pulling all this together, and I know I've covered quite a lot with you, but I just want to leave you with a couple of points. I think the global pandemic will continue to strangle economic growth and the globe in 2021. I think we're going to be living with ongoing outbreaks and restrictions. I think this fear and irrationality and change in behaviour is going to continue to dominate. I think even if we do get the vaccine coming through, people are still going to be nervous about getting on planes, going to the theatre, going to big sports events. It is going to continue to permeate our lives, I think, for at least another couple of years. And that on top of it is going to weigh on growth. In terms of the investment fundamentals, they increasingly don't make sense. And I always worry about when markets are out of whack with fundamentals, because that means some sort of correction or the markets do nothing for a prolonged period of time. So we are seeing, I think, a bit of euphoria, which is worrying me, because typically euphoria ends in tears, or alternatively what happens, markets do nothing. For your portfolio, what does this mean? First of all, do not chase outright market risk. Major equity markets are close to record highs. I wouldn't be chasing those right now. It's dangerous. We've got this herd mentality. We've got some subtleties that have got parallels with the late 1990s. Be careful here. Avoid developed market sovereign bonds. There's no coupon buffer. I think we've got a bubble coming through here. Ultimately, there's going to be a rout and a correction. Make sure you're not involved with that. You want to be invested in those parts of the market that are absolutely agnostic. And there are lots of different investment strategies that are agnostic to market risk. They're not tied directly to Wall Street or basically global markets as a whole. And you also want investments that are disconnected in behaviour. What I mean by that is that they've got different levers within them. They behave differently. You don't want things that are correlated, you want things that are genuinely diversified and genuinely uncorrelated. And on top of that, being away from market risk and having disconnection in behaviour, you also want things that are a bit contrarian, a bit unloved, a bit out of favour, but are cheap and will re-rate at some point. So there's quite a bit out there, ironically, that you can invest in and will give you something akin to mid to high single-digit returns. But you just need to be positioned away from outright market risk and also develop market bonds. So absolutely be fully invested, but it's the composition of your portfolio that's never been more important, never. So in sum, you can get a solid portfolio return, but you need to do it what I call step by step. It's not a matter of chasing returns that have been good and lofty. It's a matter of looking for parts of the market that are unloved, parts of the market that have got different levers, different investment characteristics, and also just building and expecting returns to occur gradually over time. And look, the best way I can sort of summarize this is as follows. Just imagine you're a rock climber. The advantage of being a rock climber is you have the cabinet. And the advantage of that is that it limits the amount that you can fall by. So that's the first thing, is you want to have a controlled amount in terms of downside risk. And on the upside, the rock climber, you go up step by step and slowly. At times you may have to even go a step sideways or even down to get up. but you're getting gradual, slow, steady returns. Which for your portfolio, what I'm getting at, it means capital preservation is absolutely sacrosanct. That's key. You've worked hard for your money. We need to protect your capital. Then we need to be able to give you the returns that you want with an acceptable level of risk. So what I'm saying to you, we can do that, but it's got to have the right composition, and we want to do it slowly, cautiously, and ensuring you've got protection as per the analogy I've given you with the rock climber. So my final words here, yes, the world is in chains. Yes, the world has been distorted and structurally so. Your portfolio must be adjusted to that. It must have the right compositional mix, and then you will get returns that you're after in terms of your risk level going forward for the next 3 to 5 years. Thank you, and I'll hand back to Paul.
Thanks, Bridget. So what are the key messages for our clients from that? It wouldn't be fair for us to say that markets are fair value. They're not. And it's important that we are cautious in our approach, but we still find reasons to stay invested. And I want to go back to those 3 investment principles that I spoke about at the beginning of the presentation. Building a diverse set of portfolios, making sure that we don't capture too much of the downside, we don't have to get all the upside, and staying invested through the cycle are the important principles in compounding wealth when you are building wealth for future generations. A couple of things that I want to show you here. Firstly, true diversification means investing in asset classes all around the world that derive different things. The wagon wheel that I'm showing you here shows the various asset classes that Koda deploys client money in. This is the asset allocation for a typical 70-30 portfolio, 70% growth, 30% defensive. And you can see that we are all across the globe, different fixed income classes, high yield. We build portfolios with exposure to private loans to companies, both here in Australia and offshore. Our equities exposures are either with managers who have the ability to both be long the market and short the market, or alternatively with niche managers that might specialize in micro-cap stocks. We like technology companies, but we use a specialist manager in Israel, where typically valuations are lower and outcomes are better. We have specialist equity managers in Europe. We use frontier markets because frontier markets in a portfolio don't derive their returns from what happens on the Dow Jones Industrial Index or the US 30-year Treasury. It is really important that we remain fully diversified across all of the asset classes because that allows us to build a sensible portfolio of risks irrespective of market circumstances. And here I want to show you the returns that we have been able to generate for our clients. The data that I have here on the page is for what we call our reference portfolio, the 70-30 portfolio that I described for you in the previous chart. You can see that by investing in a diverse range of asset classes and a diverse set of strategies, we have been able to deliver a consistent, steady return for our clients over time. Even in this last year gone, where we've been able to deliver primarily positive returns, we compare ourselves, the dark blue chart, against what we call the median manager, which is the selection of managers who our clients can choose to run similar portfolios to the 70-30 portfolio. It's important to note that every client portfolio at Koda is going to be different. We tailor them specifically for the clients. But this gives you a flavour of what a diversified portfolio held across time can deliver. The chart on the right shows the way that the Koda portfolio has grown that value over time compared to those median managers. And the point that I would make in that chart is that since inception, Koda has seen a number of down cycles. But you can see in the light blue line that typically our portfolios don't fall as much as the market, which means when they do inevitably recover, it comes from a higher base and we can compound wealth over time. So we're very proud of those results. And if you want to talk to your advisor about them any further, I would encourage you to do so. So that only leaves me to say thank you. I want to say thank you to our clients who have been supporting us through this extraordinary time. It's been a privilege and an honour to work alongside you. I want to thank the partners in other firms that we work with to help deliver peace of mind to our clients, whether they are people who refer their clients to us for investment advice, or whether they're supporting us with accounting or legal advice for our clients. We appreciate your support. And finally, I want to thank the whole team at Koda, who I think have done an amazing job of staying focused on delivering outcomes for our clients during these most extraordinary times. Who knows what 2021 will bring us, but what I can guarantee is the team at Koda will be here to stand alongside you and advise you whatever comes. Thank you.